Hey guys, and welcome to the Working Money channel. So today, guys, I've got a really great interview for you. I know tax season is coming up, and I know many of you guys are likely thinking about planning for your crypto taxes, and I know some of you guys even ask me, Working Money channel, what do I do? And I always tell you guys, I am not an accountant. I cannot help you with this. Well, today, guys, I am interviewing Andrew Gordon of Gordon Law. Not only is he a tax attorney, he is a registered CPA as well, and also the president of the company. So he's got some great points and some tips for you guys. I also have his information in the description of the video if you guys are interested in, maybe you need a tax accountant or something like that. All his info is in the description of the video. But he has given away some great information here. Also, he has an opinion on the Ripple SEC case. I did talk to him a little bit about that. An interesting perspective, I gotta say. So without further ado, I think I'm just gonna roll the interview. Here it is. So this is Andrew Gordon here, and he is a crypto tax specialist. He's a lawyer, and I believe you're an accountant as well. Is that right?
Yep, that's correct. I'm also a CPA.
CPA. Andrew, just tell me a little bit about you and the firm you work for.
Sure. So I am the president of Gordon Law Group. We are a law firm in the suburbs of Chicago, and we mainly practice in three areas: cryptocurrency, tax, and corporate law. But our biggest area is certainly crypto, which has grown year over year. And in the area of cryptocurrency, our main focus is tax compliance, everything from reporting crypto on your tax returns to also what can go wrong, representing clients in audits and criminal investigations as well.
Okay, so clearly, I guess, cryptocurrency, some of the people in my audience have been in it for a while. And, at the beginning, it was kind of like the Wild West. Maybe not too many people were filing taxes. But today, as of 2022, you do have to file taxes. That's right.
That is 100% correct.
I'm sure it is.
I hate to be the bearer of bad news to the people out there that were not aware that crypto is reported on your tax return. But yes, you do have to report. You do have to pay taxes on any gains. In fact, on the 2020 tax return, actually it started in 2019. We're going to see it again in 2021. There's actually a question right after your name and address that asks you if you had crypto activity during the year. So that shows you just how important it is to the IRS.
Cool. And so why is it important to report your crypto on your taxes? And can you give an example of the problems that can occur if you don't report your crypto?
Yeah, so just as a starting point, in the US, we have a system of self-compliance. You report on your taxes, and then the IRS basically takes you at your word or audits you. And so, first of all, it's your legal obligation to report all of your crypto activity on your tax return. But of course, there's still people out there that just because it's their obligation, that's just not enough. And so I'll share with you some of the reasons why and also what can go wrong. So first of all, in terms of the things that can go wrong, crypto enforcement is perhaps the #1 priority of the IRS. And even as I just discussed, they've given very expensive real estate on the tax return to this question. And so enforcement is up across the board for the IRS, but crypto specifically, we've seen more audits in the last 6 months for crypto than in the last 6 years, and we only expect that to continue. And so if you are audited and you haven't reported either in full or at all your crypto activity, there's a number of things that can occur. At a most basic level, penalties. And those penalties can range from very small penalties, 20, 25%, to much more significant 75% of the tax due. And so penalties are a big part of it. And those penalties can often be avoided if you amend your tax return report first correctly before the IRS comes to you. So at a most basic level, monetary penalties and also interest on any payments that are due. But it can get worse. And unfortunately, we've even seen it be worse for some people. It can even go into a criminal investigation if you haven't reported your crypto and the IRS thinks that you've done so willfully and that there's evidence of fraud. So for a variety of reasons. And so those are the things that are kind of the negatives and that can go wrong and why you should report. But another reason is that almost always at some point, the individual is going to cash out. They're going to sell. And we have a lot of clients that say, oh, no, I'm going to hold and hold. But at some point, you're going to cash out. You're going to sell. And at that point, you're going to be forced to report if you haven't already. And you're going to need to know your cost basis. You're going to need to know your holding period. And there are tax advantages, for instance, to holding long-term. I know we'll talk about that later. And so reporting all of these earlier activities in some situations will go to benefit you in the future because you'll establish your holding period and you'll receive long-term capital gains.
Okay, so what types of taxes are cryptocurrencies subject to then?
Sure. So the IRS actually defined crypto as property back in 2014. So up until 2014, there was a lot of discussion and debate as to whether or not crypto was something like currency, like the US dollar, or if it was more akin to property or assets like stock. And the IRS actually answered this question years and years ago, almost 8 years ago, and said that crypto is classified as property. And as such, the same rules that generally apply to property also apply to crypto. And what I mean by that is typically the rules that will apply to things like stocks. So stocks are a type of property. A property is a very broad umbrella. Stocks, crypto are subsets of that. And so, for instance, there's short-term and long-term capital gains, depending on how long you've held it for.
Yeah, that was my next question, actually, was depending on the length of time. Yeah, what's the difference? I guess you can just go into that.
Sure, yeah. Let's do it. So if you buy crypto and then sell it in less than a year, then it's a short-term gain or loss. If you hold that crypto for longer than a year and then sell it, then it's long-term gain or loss. And so the time period defines whether it's short-term or long-term. Whether or not it's a gain or a loss is dependent on the purchase price initially for that crypto and then the sales price later on. And so you subtract the two, and if you're up, then it's a gain. If it's negative, well, then you've got a loss.
You can write it off. So when should you declare your crypto to the IRS? On purchase, at sale? Like when should we be doing this?
Sure. So your taxes are filed annually. The typical tax deadline is April 15th, although for the last few years, because of COVID, those dates have changed. This year it's April 18th because of a holiday. And so you have to file your taxes by that date or file an extension. And that's the time that you would report. As long as you're an individual, you're reporting on an annual basis. So you don't need to report to the IRS or inform them, for instance, if you traded today. That said, when you report on your tax returns, call it by April 18th, you need to include all of the activity that occurred during the year, all of your sales, all of your exchanges. If you've received crypto, for instance, as income, as payment for services, that also is reportable, and that's taxed as income to you. And so all of these types of activities that happen all year long all need to be reported. And one of the few things that doesn't need to be reported is just buying and holding. But other than that, pretty much any disposition, exchange, or conversion is going to be a reportable and taxable event.
Okay, now I understand that there's this this rule, I suppose you could call it. If you're buying and selling crypto, how do you reconcile and determine which you bought and sold for which holding period? Understand what I mean there? Yeah.
Absolutely. It's a great question. I'll kind of expand on that question to give an example to the listeners out there. So for instance, say that you're doing dollar cost averaging, which is a fancy term for buying, for instance, every paycheck or every Friday, buying at a certain defined period. And so say you buy every Friday Bitcoin, and perhaps this week Bitcoin is at 50,000. And then perhaps next week it's at 60,000. And the week after that, it's at 70,000. And then the week after that, you decide, you know what? I want to go buy a car. I want some cash. I want to sell my Bitcoin for cash and then go buy a car. So then you sell, and you sell one Bitcoin. But say, for instance, you're now holding 5. You had acquired one every week for 5 weeks. Which one did you sell? Did you sell the first one that you bought? Or did you sell the last one? Or do you sell some sort of average of them all? The IRS tried to answer this question in the form of an FAQ. So the IRS hasn't issued much guidance on cryptocurrency, only about a handful of different documents, but they did issue an FAQ, which answers about 40, 50 different questions. And one of those questions was essentially exactly this, which is if you're buying and selling over time, which one did I sell? And so the IRS said that you should use FIFO, or first in, first out, or the specific identification method. And I'll expand a little bit on specific identification. But the default or general method, and the one that we recommend most for our clients, is first in, first out, meaning that if you're selling now, you're selling the first one that you bought, not the most recent one, but the oldest one first. And then you go down the line to the more recent crypto that you've acquired, but starting with the oldest first.
That's great. Yeah. So that actually just covers my next question. Why would you choose FIFO over the other method? It seems like it's a lot of extra work.
Yeah. So the IRS said you can use FIFO or specific identification as long as you can identify a number of different things. And so there's a lot of debate within practitioners as to how specific you actually have to get for the specific identification method. And in fact, we have audits ongoing right now to test exactly this. For instance, do you need to segregate your crypto into separate wallets? So in the example that I just had, where every Friday you buy one Bitcoin, well, say you want to sell the most recent. Do you actually have to have that most recent in a separate wallet so that you can show on the blockchain that you've transferred out from that specific wallet, sold from that specific wallet? Do you have to take that extreme of steps, or is it enough just to be able to show, hey, I bought it on this date, now I'm choosing to sell it? We believe that the more conservative approach, the likely approach the IRS is going to take, and from reading their FAQs, what we infer that their intention was the more extreme version, that you actually have to be able to point to a wallet address or something, a specific identifier. With NFTs, it's very simple, but with crypto, some sort of identifier that, hey, if you want to say that you're selling the most recent one, that you can actually point to the fact that you've done that. And with the blockchain, there's a lot of transparency in transactions, which is a positive, but then also could be a negative, because in some situations, you can't necessarily show which one you've sold. And that's why the IRS says, well, we're not going to give you just discretion to pick any one you want. In those cases, you have to use FIFO, first in, first out.
Interesting. Okay, and so, a lot of my audience, I don't know about a lot, but definitely there are people who watch my show who have been in this since I got into it, which was kind of late 2017, where you may have seen some gains already, or, maybe you even got in early 2020 and maybe saw some gains by late 2020 and you cashed some out already. For those who have not declared their crypto in the past, what would you suggest? How can they reconcile all of their trades from potentially years past?
Sure. So great question. And so 2020, 2021, and in the future, it's pretty much inevitable that you have to report, because the crypto question, first and foremost, you can't answer that. You should not answer that wrongfully. If you check the box no and you really had crypto activity, well, then you're potentially perjuring yourself, potentially arguments for willfulness or fraud. So certainly you have to answer it correctly. And now if you've answered it correctly, you've got to report then in 2020 and 2021, you're kind of in a pickle, because, well, what about those earlier years? And what about my cost basis and all the information from those earlier years? And how does that impact the current year? And so generally two broad options. One is that you can go back to the beginning of your activity and actually calculate or reconcile year over year. And this is something we help clients with on a daily basis, and generate what actually was your gain or loss. And in fact, we've had clients that have had losses in prior years, and then go back and amend those tax returns. So you can file what's referred to as an amendment with the IRS, which is basically a correction to your prior year's tax returns, and then report all the crypto that you haven't previously. And I would recommend doing so even if you had a loss. And in fact, in some cases, especially if you had a loss.
You write that off, right? You don't have to pay you can take it as a loss. You don't have to pay as much taxes.
Correct. Just because you're amending a tax return doesn't mean that you're going to pay them. You can be amending and in fact even get a refund if it's within 3 years. And so we've had clients that didn't report in the past because they had a loss, and then the IRS audited them because the IRS doesn't know they had a loss. They just see perhaps hundreds or thousands of trades and figure, well, this person must be a whale. They're doing well, but it's a loss. And so that underscores also the importance of reporting, because the IRS isn't going to do that work for you. And if they are, they're just going to send you a bill. And so in many situations, most situations, we would suggest going back, calculating it properly, filing amended returns if it's a loss, and even if it's a gain. If you're afraid that you're going to owe in tax, there's ways to get payment plans. And in fact, if you're going to pay tax on gains in the past, if you've been trading over the years, those gains in the past will add to your cost basis if you're trading, and now you'll have less gains in the current year. So option one is go back, fix the earlier years, and that's what we'd recommend. The other option is that you don't fix the earlier years because you don't actually have an obligation to amend. You should amend, but you don't have an obligation to. But for all the reasons we talked about in the first question, you should because of the penalties and everything else. But if you don't, that's your choice. But then when you report in 2021 or future years, you can't take cost basis. You can't take the benefits of those trades in those earlier years. So in many situations, our clients are left with zero cost basis for their activities now if they don't fix the earlier years. So the second option, being not fixing the earlier years, often results in a higher tax in the current year, perhaps even a higher tax overall.
Interesting. Now, I understand you also have knowledge of the Ripple and XRP case that's currently in court right now. I know a lot of my viewers are really interested to hear different perspectives on this. I don't know if you've, there are a couple of lawyers that are kind of part of the XRP community that have, they're kind of, they talk about it frequently, but, it's always good to get different points of view. And so, if XRP were to be determined a security, what would that mean for past and future taxes, and how would one reconcile this? I.e., for example, like if traders might go between XRP and Bitcoin, security versus non-security. I guess we'll get to the XRP question in a sec, but let's just touch on that first. Like if you're to trade crypto to another crypto, if there's a security issue there, is it even an issue?
Sure. So from a tax perspective, it's actually not really an issue because property, which crypto is defined as, is a very broad umbrella. And it encompasses things such as securities as well. For instance, stocks, mutual funds, all those things, clearly securities, but they're also property. They're also subject to the same rules. So if you traded shares of IBM or you traded Bitcoin, they're actually reported on the same place on your tax return. And a gain from Bitcoin, a loss from Bitcoin can offset a gain from an IBM stock sale or vice versa. So the two, from a tax perspective, actually, there's no tension between the two. If it's a security or not, it's all within the property umbrella. Generally, there's very limited circumstances where that wouldn't be the case if it was some form of equity, but none of these tokens out here really are of that form. So from a tax perspective, not really an issue, but certainly the Ripple case will have potential impacts on the token ecosystem as a whole, and whether or not certain tokens are securities and how the SEC will go to enforce that. Because the SEC has been very active in going after different token projects alleging that they're securities, but they've been doing so under the basis of what's referred to as the Howey test, which was a test that was designed decades ago, long before cryptocurrency, I think even long before the internet. And so we're trying to use a test that was designed in a completely different circumstance and apply it today. And yes, in many ways it can work, but at the same time, I think it's important for the courts to have a fresh pair of eyes to analyze these issues and try to determine, is there a more appropriate test, or what should the test be for cryptocurrencies? You often hear the discussion utility versus security. The Howey test actually doesn't use the word utility, something that the crypto community came up with to try to differentiate themselves from securities. So I do think that the case will likely go to a trial, will likely have some sort of decision, and I'm optimistic that that'll create greater clarity for the crypto community as a whole going forward on what can you do, what can't you do, because almost every day I'm talking to different projects about different things they want to do, from doing airdrops or distributing certain rewards, and right now there's very little clarity from the SEC.
Do you think Ripple has a strong case?
That's a very tough question. I certainly think there are aspects that will count against Ripple in terms of being a utility. I think at the most basic core, the Howey test is predicated on whether or not someone is investing with the goal of increasing their value or having profits based on the work of someone else or of business. And for the most part, that's why people were investing in Ripple. Of course, there are arguments of the utility, but especially in the ways that the Ripple company, which the name is escaping me, marketed itself, it wasn't as much towards the utility. So I do think that there are some very strong concerns in their case.
Yeah, and what about the SEC? What do you think of their stance on it?
Well, yeah, no, I think the SEC is going to continue to rely on the Howey test, because in the absence of any other court decision, that is the law. And when looking at the Howey test, yeah, I think that there are some issues with Ripple, and that it will fit more into the securities type definition. That said, will the court use that same standard, or will they do something else? And this is a case that may drag on and go through appeals in several layers, but hopefully at the end we'll have greater clarity and some sort of decision and definition as to what a security in the context of cryptocurrency really is.
Interesting. Yeah, I wish we could talk longer. I think our time's almost up, though. Anything else you just wanted to mention about yourself, your firm, anything that the kinds of services that you provide?
Yeah, so if you're listening out there and you're saying, oh, shoot, I'm definitely one of those people that have not reported crypto over the years, or maybe even you got in 2021 and you've done very well, or you've got a lot of activity, we can help you with the tax reporting. We can do the tax reporting and also file your tax returns, or we can just do the crypto calculations and you can use your existing CPA. So those are all services that we provide. And then also we have a lot of free information on our website. We've got a crypto tax guide. We've got a crypto tax webinar. So a lot of great resources if you want to try to do it yourself as well.
And what's the website again?
It is GordonLawLTD.com.
All right, I'll link that in the description of the video for everybody watching out there. Anyway, just wanted to thank you for joining us today as a special interview, and we hope to have you back.
Well, thank you very much. It was a pleasure.
Thanks. So there you guys have it. That was Andrew Gordon from GordonLawLTD.com. Gordon with an O. Not only is he a crypto tax lawyer, but a crypto tax accountant as well. So if you guys are needing some assistance, all Andrew's information is down in the description of the video. I also just wanted to mention this was not a paid promotion. We reached out to Andrew just to give us some insight. We know tax season is coming up, and I know a lot of you guys were probably wondering, what the heck do I do? Also, some interesting insight with the Ripple XRP case, from his point of view. And to be honest, I did not know what he would say before I interviewed him, but he does say, there are some questionable things about the Ripple case. There is some evidence to suggest that, the judge could lean on the security side. Nevertheless, the SEC is using the Howey test, a very outdated model. And so, just based on that, we know in previous cryptocurrency related cases, it has been very, very difficult to come to a conclusion. So the Ripple XRP case, a landmark case, are we going to get some real meaningful regulations out of this? I don't see why we wouldn't. But that's just my opinion. I want to hear what you guys think. Please subscribe to the channel if you haven't already. Like the video if you like the content I'm providing. I always love hearing your comments. See you in the next one, guys.